Thank you for joining us this evening. I know we've had a full day of Zoom meetings and looking forward to a nice educational session on real estate. All right, I think we should start since it's a late in the evening. We're very glad to have here with us Michael from Investcorp to speak with us about the US multifamily segment that Singaporeans actually don't see so much of. We are all very familiar with retail and industrial and logistics. But multifamily is a very unique sector, something that we are actually familiar with, but we don't see so much as an investable sub asset class or within the real estate sector. So very happy to have Michael here with us. Maybe just a quick introduction on iSTOX, and then I'll introduce Michael, and then we can kick off. For those of you who are familiar with iSTOX, and maybe for those of you who aren't, we're a private markets platform that opens up accessibility to private market investments such as hedge funds, private equity funds, private REITs, corporate debt. And very excitingly, we have a couple of real estate funds on our platform, one from Mapletree, which is their Europe Income Fund, which invests in Europe commercial real estate, and Elite Logistics Fund, which is a portfolio of European logistics real estate. We also last year launched Unicorn Opportunity Fund for those who want something that has unicorns in them. But without further ado, I think tonight's discussion will be super interesting because it's an asset class that I think we know and sort of familiar with because Singaporeans are very, they like residential. We all invested it in some shape or form. But the Americans, I think, have taken it to a new institutional level. And so today we have Michael O'Brien oversees Investcorp's residential investment activities in North America. Michael's been with Investcorp now for really a number of years now. He started Investcorp in 2007, and he was the head of asset management for all of North American real estate. He currently focuses on North American residential vertical and has over 2.8 billion of assets under management. Investcorp itself is actually one of the top 50 investors in US real estate. Prior to joining Investcorp, Michael was with ING Clarion Partners in his New York office since 1995. Now, I won't go through too much detail because I'll let Michael talk through what he's done and Investcorp and how they have actually been spending a lot of time. And as you can see, 2.5 billion AUM in just residential in US is pretty impressive. So off we go, Michael. Over to you.
Thank you for the introduction. I don't have to add any more to my resume. That was perfect. Summarizes it. But just quickly, thank you all for joining this evening. I hope everyone's healthy and safe. We're slowly getting back to work in the U.S. As you can probably tell, I'm in my office on Park Avenue in New York right now. People are back on the streets, and we're slowly coming back. And I hope the same for you and everyone in your family too, that we get out of this. Before I jump into apartments and multifamily, I just have to do a quick introduction or a commercial for Investcorp because everyone may not be familiar with us. We have been around for a while, but we were established in 1982. This isn't, we're not a first-time fund or a second-time fund or even a third-time fund. We have $35 billion under management on behalf of investors. We invest in 4 strategic areas. So private equity, which we're probably most known for. Historically, we've invested in Gucci, Tiffany, Saks Fifth Avenue. We've owned a lot of retailers. We've owned a lot of companies through them. We invest in real estate. We invest in credit, so loans, and also hedge funds, which is referred to on here as absolute return investments. But our real estate portfolio represents about 20% of the assets under management for Investcorp. We have 160 investment professionals within Investcorp, so we're pretty big. We're global in nature. We have an office in Singapore, and if you don't know YC, she heads up that office for us. But our main offices are in New York, where the investment professionals are. We're in London and we're in Bahrain, where our headquarters, back office, and our C-suite executives all sit. But I just want to let you know, we're global in nature. We've been around for a long time. People may not know our name, but we have a long, long track record. On the next slide, we'll get into US real estate, or just global real estate. Once again, we've been doing this since 1982. And if we go back to even just 1996, which wasn't that long ago, we've acquired $20 billion of real estate. Investcorp has, on behalf of its investors. Not a lot of firms can say that. We currently have almost $7 billion of assets under management. Primarily, that's 80% is in the US, so-called North America. And then we have a London office, which invests in European real estate. And then we have an Indian office that invests in assets there. The team has been around a long time. The average tenure is 20 years. We have over 30 years of investment experience. And we've been super active, both on the buy side and the sell side. So the takeaway from this is we've been doing it for a long time. We're not a first-time fund. We're probably on our, I'm going to guess, 30 or 40th fund at this point, and delivered good results to our investors. On this slide right now, you'll see we invest in 4 major asset classes right now. So apartments, which I'll explain in a minute, multifamily, industrial, office, and student housing. We don't own any retail currently, and we don't own any hotels, which quite honestly has been a blessing during this pandemic, that we are in no workout discussions with any lenders. You know, if you borrow on your property and you can't pay the debt service, we have not defaulted on any loans. We're current on everything, and we're not in workout. So what I'd like to tell people is we're actually playing offense right now, as opposed to defense during COVID. We can be super active on this side. Within Investcorp's AUM, we'll stay on this slide for just one more second. We have $2.5 billion invested in apartments, multifamily, which we'll talk about in a second. And then we have a little bit invested in student housing, which will fall underneath that. One more thing to note, we're invested across the US. This isn't just major markets or even the Midwest. We're diversified across the country. We're primarily focusing on the top 30 markets. So by population and job growth, we have a screening tool we look at to determine which markets to invest in, but it's typically the higher growth markets. If we go on to the next page, this is just an advertisement for us. If you haven't heard of us before, we're the 3rd largest cross-border buyer of US real estate over the last 2 years. Not many people know that. We're the #1 Middle Eastern Gulf-based investor over the last 5 years, and the top 10 cross-border. I mean, we hit all the rankings. We probably haven't done a good job of marketing ourselves, but let me tell you, we're out there investing and we're asset managing this on your behalf. We probably do need to spend some more time, but we're very active. We're very recognized. I think the other takeaway from this is that we borrow from all the major money center banks. We don't have to go to a local regional bank. We can borrow from all the governmental agencies. We're platinum sponsor. We're preferred borrowers from all the. We borrow from all the major banks in the U.S. So we're highly recognized. We can close quickly. And one other thing I'll note is Investcorp is very well capitalized. In all of our portfolios, we're able to buy these assets on our balance sheet and then place them with ultra high net worth or any investors after that. We can do that with our own capital. We don't need third-party capital in order to acquire the assets. On the next page, I always put this in, but I would tell you this is the team, Investcorp in New York, so our North America group. I think the takeaway from this is we have 19 investment professionals in New York. Average time at Investcorp is 7 years. Within the top 3 people, so John Dracos, who's global head, Herb Myers, who runs our commercial vertical, and myself have been here on average 20 years. We've worked together. We've been through cycles. We've been through the great financial crisis. We've gone through COVID together. We even went through things before that. So we know the downs and ups. We know how to work together. We know how to operate together. I wouldn't say we know how each other think, but we all sit on the investment committee together. And the 3 of us have over 30 years of experience. So we have a deep bench. We've been together a long time, which is helpful when you get into crisis like COVID. You need to know how to operate and how your partners are going to operate. in difficult, challenging times, and we have experience. On the next slide, I'm not going to walk through each of these bullets here, but let me just explain to you what apartments are, multifamily, and what we're specializing in. So big picture, there's 330 million people in the US. There's 124 million households. And to break that down, that's married couples with kids or whatever. So on average, each household, each person who either owns a place or rents it, there's 2.5 people in that unit. Okay, so we have 124 million households in the US. It breaks down roughly 60% in the US own their primary residence, and roughly 40% rent. If you look at Singapore, I looked this up, 90% of the Singaporean population owns their own home and only 10% rent. So I understand it's not a very common practice in Singapore for rental, but it's a very, very established market in the US. By the way, just by way of comparison, 50% in Hong Kong own and 50% rent. So it's very, very established in the US. So within that, it's roughly 36% rent in the US. It breaks down into different categories. The type of assets that we invest in represent 10% of the 124 million. So there's roughly 12 million apartments, institutional quality apartments in the US to invest in. So there is a limited supply. They are building more, but let me tell you what we invest in. We invest in class B to B+. We're not buying the brand new trophy high-rise tower. And the reason for that is the people who live in those are the people who are renting by choice. They have a choice. They can either buy a place or they can rent a place. And when it comes time for them to buy, they tend to they'll go buy when maybe they're renting for a year while their house is being redone or they're relocating. We like the renters who they can afford the rent, they can afford maybe a mortgage payment or the interest expense on it, but they don't have a down payment. In the US, you need 20% equity in order to buy a place, in order to get a mortgage. So it's very difficult for people to accumulate 20% in order to go buy a home. So we call those people renter by necessity, meaning they will always be renters. They can afford the mortgage payment, they just won't be able to get the down payment. We've also found during this last cycle, so the last 10 to 15 years, as millennials come into the workforce, they tend to be renters. Millennials are getting married later in life, which means they're not forming households, they're not having children. Therefore, they want to rent. You buy a house when you start a family and you need more space. The typical millennial is graduating with over $30,000 of student debt. 20 years ago, that was like $10,000 or $12,000 when you graduated. $30,000. So they're starting in a hole. It's hard for them to save money when you have to pay your student loan. It's hard for them to save money when you're continuing to make payments. It's difficult for them. It's challenging. So we think this trend is going to continue. The other thing I will note about apartments and why people in the US like to rent is it used to be, I remember my father, he didn't work at IBM, but it was a company like IBM, and he worked there for his whole life. That was the trend. You got a job, you worked there your whole life. The latest trend is millennials tend to hop around. They'll be in one job and then they want the flexibility to move to another job. And if you own a home, you can't do that. You need the flexibility associated with renting. And I think what's happened during COVID has proven even better is that renters, millennials have determined, and actually people in the US have determined, that if they owned in the US in a major market in New York or Washington, DC, they didn't have the flexibility to move out to someplace in the suburbs, so more rural during COVID. And I think people really recognize the benefits of renting today. So very established renting. There is growing demand for apartments, as I said, millennials, and we're also seeing the baby boomers who were born between 1946 and 1964. As they age, They're selling their homes, which is basically their retirement savings, and they're renting. So very good trends. As I said, we're buying the Class B, so maybe 20 years old. These properties are 20 to 30 years old. They're still in good shape. The good thing is they're not building any more Class B. Developers all like to build Class A, nice and shiny properties. No one says I'm going to go out and build a Class B apartment property. So we think there'll be great demand. Another thing I'll point out is we've proven during this pandemic, during what I'll call a recession, that apartments have been recession resilient. We actually had a real test case on our hands where we went through and people were out of work, people weren't going to work. On average, we collected 95 to 96% of our rents during this period of time. People renewed. We had 65% retention. People weren't leaving. So if you ever had to do a test and they go back and look at, is this a good asset class and what happens during a recession, and you do all these modeling, we actually had a real one in place that just occurred. And we were 96% collected. We maintained 95% occupancy. We didn't see any real rental growth. I'll be honest about that. It was flat, but the way we borrowed, we had floating rate financing, LIBOR based, and during challenging times, interest rates go down. So during this challenging time, interest rates went down, and we had more free cash flow for our investors during the pandemic than we did before. We made special distributions. By the way, I don't know if we're going to continue to do this for you, but this is something that we saw. You borrow with floating rate financing, you have flexibility, and during difficult times, interest rates will go down and you have more free cash flow. It turned out to be a good investment. As I said, and they've been stable during the recession. And we're also seeing the buyers and sellers today are very institutional quality. It used to be a very mom and pop or family run business owning Class B. We're buying and selling from Blackstone, KKR, Starwood, names you might be familiar with. They are our competitors out there in this space. But we've been doing it we've been around longer than Blackstone has. We've been doing this. We have more of a track record. They're just bigger than us. But we think we have a competitive advantage. We're a little bit more nichier. If we move on to the next slide, a lot of this I've already covered, but maybe one thing is, why is Class B or any apartments very attractive today to investors, and why is our product oversubscribed with our investors? And I think it really comes down to, where else can you get a good cash yield above a risk-free rate? This is the spread. It really is. Investors, as they look for more income, as they're retiring, what they want to know is, where do I get my income? If there's appreciation and upside, that's great. I can actually get that through the stock market. I can do other investments. But if I want real cash flow, I want income, I want a 5 to 7% cash on cash with very little risk, as we investing in an asset class that just went through a pandemic. That's why we have more demand today than we've had before because of this. And the outlook is good too. As we're coming out, jobs start to come back, we think we'll see real rental rate growth. And as we have an inflation, I think everyone asks about inflation and what happens when prices go up. That means hopefully people are making more money. And on top of it, when you make more money, you can afford a higher rent. We're also seeing today a pullback in the amount of supply, new construction. Lumber prices are up in the US. Imports are up in the US, which costs more to build an apartment property. So therefore they need higher rents in order to build. So inflation isn't a negative for real estate and for Class B apartments. If we look at the next page, these are just some charts to look at the unemployment rate. On the first one, you can see that we have declining unemployment. Cities, states in the US are reopening. I've probably been on 40 airplanes during COVID to travel around to see our properties. We're very hands-on with our assets. I can tell you the major cities are slow to reopen, but the Dallas, Texas, the Atlanta, Georgia, Phoenix, Arizona, any place in Florida is up and running. Disney World is now up and running in the US. So things are opening back up, and I think that you'll see that unemployment rate drop. People tend to we're a renter society. We have more people who own homes. It used to be the American dream to own a home. I don't think that's the case anymore in the US, because as I said before, it gives you the flexibility to move to a different city. If someone in your family says, I think I want to go to Atlanta, you live in New York and I want to go to Atlanta, Georgia, there's a good job opportunity, you own your home, it's hard to move. To sell your house, there's transaction costs. Renting gives you much more flexibility. Let's see, and then on this next page, this is just a chart of how we select properties, what we're looking for: strong population, income. We don't take a risk on a smaller market. We're not trying to go after and chase a higher yield just because it's in a tertiary market. We want to stay in the primary markets where there will be some type of liquidity when it's time to sell, where other investors are investing. We look for diversified employment. We don't want to be in just a technology market, which was what we've seen happen in San Jose and San Francisco recently. It was great during the run-up, but during COVID, people moved out. The technology jobs maybe end up working from home, and which has had an impact on the apartment sector. So we want a diversified economy, not reliant on one energy sector. And we don't invest in major cities, or we haven't historically. We like garden style, suburban, good school districts. And then we have a list of some of the markets we're focused on, and you may not be as familiar with them, but we call them, they're in the Sun Belt markets. These are states that have a lower cost of living. By the way, they're highly recognized: Atlanta, Georgia, Dallas, Texas, Phoenix, Arizona, Fort Lauderdale, Florida, Orlando, Florida, Tampa. Major markets, low state income tax or no state income tax. People are moving to these jurisdictions. In the US, if you live in New York, you might pay 12 to 14% in state and city income tax to live in New York. On top of what the federal government charges, you can move to Texas or Florida and that 12% goes to 0%. They don't charge any taxes in those states. On the next, actually, maybe just to wrap this up, Investcorp has a long track record. Our performance has been above PPM on all of our most recent portfolios, and even dating back, we've been delivering 6 to 8% cash on cash returns to investors, even during a pandemic. And our IRR is, I would call it mid-teens IRRs. So above PPM, we usually target 9% or 8 to 9% IRRs, and we've been able to outperform even during difficult times. And we're investing in cash flowing real estate. Maybe one last thing is we have 4 offerings a year. It's something we bring out, and they're all cash flowing. There's no opportunistic or development. We leave that for other people to do.
Thank you, Michael. That was super interesting. I think one of the things that really struck me, and perhaps you could comment on that, is while we I think the death of the office is slightly overrated, but I think it's quite clear that everybody working from home has come to a sudden realization that maybe the home needs a bit of upgrade, right? I mean, what kind of, are you seeing that trend? I mean, you talk a lot about moving from high, obviously very expensive cities to the suburbs. Do you think the thinking around COVID and working from home will have a slightly more permanent effect as well?
Yep, that's a very good question, because what we found, one of the things we've done during COVID is to make sure that the Wi-Fi and cell phone service at all of our properties is top notch. So there's one thing we've learned, is that you can't be on a Zoom call and then your kids be doing something, and when people are at home and then someone decides they want to do a Netflix video and it hogs up all the bandwidth. We have gone in to make sure that is the number one priority, above and beyond having a 2-bedroom versus a 1-bedroom, 3-bedroom. That's the number one request. Two, all of our properties have some type of upgrade program. We call it light value add. We're adding in new countertops. We're bringing in stainless steel appliances. They're faux stainless, they're not real stainless steel. They're faux stainless. We're taking out, the new trend is no one likes carpet in their apartments. They all want a hard surface that we're putting down. By the way, it's much cleaner, it's easier to maintain, and it doesn't cost us as much when someone leaves the apartment. You can just repair a little patch as opposed to ripping up the carpet. And we're providing more outdoor amenities. That is one thing we learned also. You need to have the dog parks, the playgrounds, some type of place to exercise, some type of little paddle ball or tennis court, little soccer fields. So we've adapted during COVID. We don't just have the same property we had before. And people want these things and they're willing to pay if you have it.
So, for the benefit of some of our investors here, we are very familiar with REITs. I mean, REITs have been around for us, 20 plus years. We have some representation of non-Asian assets, right? We have United Hampshire, which is a portfolio of suburban retail malls. But, so we're very familiar with office, grade A office for sure. We're very familiar with retail, suburban retail, and the different types, logistics, industrial. So how would you categorize multifamily relative to all of these other asset classes, both in a positive or a negative way?
I'm sorry, could you just repeat that again? How do I characterize multifamily compared to REITs?
Compared to other office sector, other real estate sectors, like office and industrial, and where is it? When or where is it more resilient? When or where is it potentially, potentially more vulnerable than the other asset classes?
So I would tell you the most vulnerable asset class is hotels because the rents get priced daily. So when there is a downturn, the rents, the hotel rates are priced the next day. And we saw during the last crisis that when people stop traveling or businesses slow down, hotels get impacted the first. By the way, on the flip side, it's the first to recover when things come back because you can price those rents daily. Apartments are annual. People sign 12-month leases. So it's more resilient on the downside and on the upside. I would tell you on office, tenants sign 5 to 10-year leases. So when you have a downturn, it might be okay. But if a tenant goes out of business, they're not going to pay their rent. But on the upside, you don't get it as quickly. So we think this is a nice niche between hotels and retail. We think apartments are. I think by the way, industrial wasn't even an asset class 10 years ago until we started seeing the last mile and Amazon take up everything and next day delivery or in-time delivery. And we have a big infrastructure and we're buying industrial. I think industrial and apartments, if you read anything that the other institutional advisors, the Blackstones, the KKR, Starwood are all writing about, it's these two sectors. Apartments, they've proven the most resilient, as I said, during a downturn, and industrial. Office, I personally think the story hasn't been written yet in terms of what is going to happen with COVID and how much office space do you need, and will we have a hybrid work environment versus at home, and will you allow people to work home? The story hasn't been written yet. I think it's too soon to get back into office.
Thank you. We have a question here. Do you allow your renters to purchase any of the property? So do you strata title, and subsell the units with the portfolio?
No. By the way, if the renters would probably tend to go buy a house versus buying the property, but no, they don't have an option. Maybe that's, I don't know, probably there are other countries or markets that do have that practice, but we don't give our renters an option. You know what happens with that is you start to get a bifurcated property. You have some people own, some people are renting, and we think it creates this not infighting, but two different classes of citizens at your property, the owners versus the renters. And then it's harder to sell the property at the end if you have fewer units. So we tend to stay away from that, but it's not it's done in the US, but it's not that accepted.
Right. Yeah. I mean, we see that with some of the older retail malls in Singapore where it was strata titled, and the owners
Yeah,
can't agree on, management and sale prices, and it's just
correct.
messy.
It's called, we call it in the US, I don't know, condominiumize. So
Right.
you have a condominium ownership in it. And it is not common, but it is done. But it's difficult, it's challenging.
Okay. And I'm sure a lot of our participants tonight will have a very big question around where do you see the US? I mean, we just entered into a lockdown, so we're sort of slightly bit nervous and slightly bearish. But where you're sitting, where's the US? Where's it coming out? Are you worried? Is the US worried about another wave? And do you think, you could power through that in the next sort of few months?
Yes. So people were scared a year ago. People were really scared. We went into lockdown. We kind of opened up towards the end of the year, the calendar year 2020, and then went back and down into lockdown again. This is all prior to having a vaccine. So as much as you see or maybe see the press and people are running around the streets of New York without masks on, that wasn't the case. It's starting to open up now. And I think they've done several, I'll call them test cases, whether it's Florida or Texas, where New York and California had mask mandates. Florida and Texas didn't. And we did not see a spike in cases associated with that. And as we've been vaccinated, I think it's even better now. People are more comfortable going out. By the way, people still wear them. So as we come out of this, we think there'll be more jobs. By the way, it's hard to hire people right now. The government is providing incentives, providing tax benefits, to people who lost their jobs. So that got us through the difficult period of time. But people are starting to go back to work, and we think it's only going to get stronger. We think we got through it, and people are going back to work. People are going back to work. But I think the one thing we're watching is inflation and prices going up. Yes. But as I mentioned, real estate's been determined or proven to be a hedge against inflation. So if you're concerned about inflation, if your investors are concerned about it, real estate's a good place to be in.
Absolutely, especially with annual leases, right?
Yes. Yeah.
But we sort of the headlines at the moment, at least out here, is that the U.S. housing market is booming, right? And is that kind of how does that apply to the way you are thinking about acquiring properties into your portfolio? Does that necessarily make it quite difficult for you to execute any acquisitions? Generally, especially in your markets?
Yeah, let me break down the housing market between the apartment market and the single family home, because both are booming right now. But on the single family home, there is very limited supply for people to buy homes today. If you wanted to go buy a house in my neighborhood, by the way, New York City, Manhattan is different. But if you try to go to the suburbs in any major market today, whereas you historically had 7 to 8 months of supply of housing, it's probably down to 1 or 2 months today. Very limited, which means, how supply and demand work, which means prices are going up. People can't afford, it's getting more difficult to buy a home today, which means our renters are going to have a more challenging time, and they'll probably be renting for longer. That's on the housing side. On the apartment side, it is becoming more competitive to buy, but we are starting to see more rent growth. So there's two things going in. It's harder to buy today, but you need to understand when you historically have collected 99% of your rents prior to COVID, and you're currently collecting 96, we're going to get back to 99%. So we should automatically see a 3%. We're forecasting it's going to take us another year to get back to those collections. So we're forecasting a 3% increase there. We haven't had any rental rate increases in a year. That was one thing we did in our portfolio. We said we'd rather maintain higher occupancy than try to push rents and lose people out of our apartment properties. It was also the right thing to do to keep people in at the same rent. Yep. So we think there's an opportunity to push rents. So yes, it's more competitive to buy. It's harder to buy today, but we think the fundamentals are still really strong and interest rates are low, and it still provides a good risk-adjusted return against whatever benchmark you want to use. Here we use the US Treasury rate as the risk-free rate. So we're still finding opportunities. They're not easy to find. But if we stick to, so we don't have the whole US, if we stick to the markets we like, we think we'll do better than trying to chase the yield. So we're bringing our yields down a little bit.
And would you, I mean, we talk a lot about developed, completed properties, right, that are already leased out. Would you work with partners, or do you have a strategy around development or greenfield, or that's something you would rather work with someone else on?
We shy away, or we don't do development. We did it during the last cycle. If you get caught at the wrong moment in time, the problem with development is you don't have cash flow to service your debt. So now you need to come out of pocket to make the interest payments. So we've determined that, and when there's cost overruns too, you have to come out of pocket. You make a lot of money doing it. We would rather deliver a good, steady, we call it steady Eddie, cash flow return to our investors, as opposed to try to shoot for the stars and get a higher return. We're more about preserving the principal and getting them a consistent yield that doesn't fluctuate as much. So we are not doing development these days. There are people out there who do it. They can get great returns, but you're not going to get cash flow.
Yeah.
You're not going to get annual distribution or quarterly distributions from your investors.
So, just sort of coming back a little bit, there's a question around COVID-19. At least in Singapore, I'm not sure that we've completely played out the economic damage of COVID-19 on the economy. Do you think that there will be a slightly delayed response in the US as well, and therefore potentially leading to, you having to take back some apartments, or, finding difficulty in getting a rent?
Yeah. By the way, I think the challenge we had during COVID was states in the US, cities and states imposed eviction moratoriums, meaning you were not allowed to evict tenants if they didn't pay their rent. We were very concerned about that. When you tell someone you don't have to pay your rent, by the way, you don't have to pay it today, you'll have to pay it back at some point. And the US government told people they didn't have to pay their rent. There are some people who didn't pay, who would walk in with their bank statement and say, I have $20,000 in the bank, but I was told I don't have to pay. But those were very rare examples. 95% of the people paid their rent. You know why they paid their rent? Because they didn't want to be the person at the property who the people pointed at and said they didn't. If everyone else is paying their rent and you're the one person who doesn't. So people, you probably pay your cell phone bill first and then your rent in that order, and then your car payment after that. And food obviously comes in at the top, and your child's education. But we found that people actually, so we're not concerned. We were concerned about a moratorium or saying you weren't allowed to evict, and people still continued to pay their rent. The other thing we're watching is just the subsidies, the US government. They're slowly taking those away from people, and people are still paying their rent. We haven't seen a drop off.
I think that's great, right? Compared to some of the other, office and REITs or landlords and retail. That's a disaster, I think.
If you have retail, and your tenant leaves, I don't know who the new tenant is to come in. Yeah. I just don't know. There's no new retailers starting up. And if anything, people are going online more than COVID accelerated the shift from retail to Amazon or next day delivery. A lot of these retail properties, as we're seeing in the US right now, are going to be repurposed and turned into either warehouse, or they're going to be torn down and they're going to build apartments. There's also a little bit of a trend to converting them to office space. It's not a high-rise office, but the rents are much, much less.
Right.
Than you would get in an office.
Suburban office, right?
Correct. Yeah. So it's apartments have stood up during, as I keep saying this, during COVID, in terms of the actual cash flow we've been able to generate.
Speaking of cash flows, somebody is asking, how much leverage are you getting from the banks today on multifamily assets or portfolios?
Yep.
And I'm adding a question. Are you seeing the banks, are they feeling nervous? Do you see a slight sort of shift, or, any dynamics within the financing market?
One of the beauties of the US is when you have, there's so many different investors, there's so many different banks to borrow from. We've historically borrowed from the governmental agencies, Fannie Mae and Freddie Mac, and they have paused. They have an incentive right now to lend to Class C housing. There's an affordability issue in the US, which we're kind of taking care of in the middle, but we don't go down to Class C, and the governmental agencies are now lending to those groups. So they're not as active. We were the top 5 borrower last year from the governmental agencies. I mean, we're a platinum sponsor. They call us and ask us what's going on. How come you're not borrowing from us? They weren't competitive, but we were able to find CIBC and MetLife. There was just someone else stepped into that space. We borrow somewhere between 65 and 70% loan to value, depending on the property, depending on the risk profile. We did one at 75%, but call it 69% is our sweet spot. We don't want to be over leveraged, and it's not really a loan to value that we're looking at. We're looking at the free cash flow. For us, it's all about how much cushion do you have if rents were to drop. So if it's 2 to 3 times, you want to have 2 to 3 times your income sometimes over the debt service. So you can make it even in a downturn.
We have one question here around besides inflation. We talked a bit about that and the impact on multifamily. Are there, what do you think are some of the next biggest risk factors, and how do you think your portfolio is defensive against that or resilient against that?
I think we're watching, and there's nothing on the horizon for this, but if the government decides, which they did during the great financial crisis, that they were going to open up the lending spigot for people to buy homes. It used to be anybody could buy a home during the last crisis, right before the last crisis, which we had apartment occupancies drop during that period of time because the person who drove a taxi cab, the person who shined your shoes, the waiter and waitress, they could all buy homes 0% down or 1% down. And on top of it, they had what were called liar loans, where you didn't actually have to submit your financials in the US. You could actually just say, I made a certain amount of money, and you could borrow it. That's what happened. Because the government, the president and Congress decided they wanted to have home ownership be a high priority in the US. They wanted people to own homes, and we see what happened with that. So we are down in Washington, D.C. on a regular basis. We're tracking what's going on to understand if this will be a new initiative. But it's not. It's nowhere. I think that the pain is still, we can still feel the pain from what happened last time, and people, saw their parents lose homes. And I don't think we're going to get to that. But that's something we're monitoring closely, is any governmental initiatives to buy homes. But I don't think that's going to happen.
I think we have time for 1 or 2 more questions. So if anybody want to squeeze a couple more in. We have a question here that's a little bit more a curiosity question, and maybe I will just sort of paraphrase that a little bit. Investcorp works with property managers across, I suppose. You don't have enough people to manage a national portfolio. But when these property managers work with their tenants, what happens when the tenants actually the damages, or they damage the apartments, which presumably happens more often than we think. How do you work with the property manager with tenants like that?
So 2 things. One, we do have a property management group within Investcorp. They manage a little more than half of our portfolio. We like to use the best in class in a market. So while Investcorp owns a property management firm, they don't manage everything. They manage just a little more than 50% of what we own. We like to use whoever's the best in Phoenix, Arizona, or Dallas, Texas. And it may not be our group. We've hired and fired our own group certain times if they're not performing. So, but your question was really around, how do you monitor damage at a property? So we take, first of all, there's a credit check up front that's done. People have to submit their social security number or a national ID number. We do a background check on every resident who comes in, not just for credit, but for crimes, Have they paid their rent in the past? It's a full background check. Then based on that, by the way, if they've committed a crime, we don't rent to them. But secondly, we will require a security deposit from most of our residents, meaning they have to give you 1 month's rent in order to guarantee that they can pay for the damage and the rent on the backside. There are also third-party services these days who will guarantee the rent. So if the resident, making it up, can't come up with a $2,000, doesn't want to come up with a $2,000 security deposit, they can pay $20 a month or something like that and have an insurance company guarantee their lease for them. So then we can go to the insurance company, which is actually much easier than trying to get it out of the resident. So we have cash security deposits. Sometimes it's substantial, sometimes it's not. We do monitor performance and we do background checks, very deep background checks. And we have a minimum criteria. You have to make 3 times the rent, monthly rent, in order to live at our properties.
So let's do one last question. I'm gonna, stick in my question here. You've been in this market for decades, right? You've been looking at this multifamily and residential market for decades. What would you say was the highlight of that, experience, and what would have been the worst, point in time, where you thought, the sky was falling?
I would tell you, so you're not talking specifically about apartments. This is just about real estate in general.
Multifamily, you can.
Okay, for multifamily, well, I was going to say the worst was hotels for a second, but just because they were, as I mentioned before, so volatile that in a downturn, I mean, it just happens overnight in terms of the cash flow. And one more thing I'll mention, and everyone likes nice hotels and, the Rosewood and Ritz-Carlton and all those groups are not necessarily your partners because they don't have an investment in the property, but they hold you to a very high standard and make you reinvest in the property. So I found hotels. So on the multifamily side, I'm trying to think that, by the way, we didn't prepare this one ahead of time in terms of the question. So by the way, as I said, I think, the most surprising and best thing was during COVID, as tough as we were worried and working relentlessly to collect the rents, people in the US paid their rents. I honestly wasn't, I don't know why, I just wasn't expecting that. And I think on the flip side, we found that on the office side, tenants played more games. The office tenants and retail tenants tried to play more games. Even though they could pay the rent, they thought it was a get out of jail free card or a free pass to not try. By the way, they ended up paying, but it was a lot more work on that side. I think the other thing is we got into this space, the Sunbelt market, Class B apartment investment strategy 10 years ago. We had it all to ourselves. It's become more competitive. By the way, we will find the next strategy. We're working on it right now. We don't have it all put together, but we will find it. We found it before. We were on to the last mile industrial 10 years ago, and that strategy. Now everyone has trailed onto it, and we're working on our next strategy for that. So we've been able to get the markets right too. As I said, we don't own in the urban downtown CBDs. We don't own the high rise. We don't own the Class B. We don't own the Class A. It's all Class B.
With that, very interesting. I mean, I'm sure we could spend a few more hours talking about the US real estate. It's so fascinating. And in fact, obviously the Singapore REITs took a lot from what the US REIT started with many years ago now. But anyway, we'll have another time with you. Thank you very much, Michael, for a great session. I think we all enjoyed it. We look forward to speaking with you soon. And, for everybody out there, if you want more details, I think the video would be kept on the iSTOX website, the YouTube website, and we'll send you a link if you'd like. But thank you for joining us this evening and hope to see you soon.
Thank you.
Thank you, Michael. Thank you, Investcorp team.